Let me be honest with you for a moment. Most people don't lose money investing because they're unlucky or bad with numbers. They lose because of small decisions they don't even realize they're making. And the hard truth is, about 90% of people end up losing money at some point. Not once, but repeatedly. In this video, I want to talk to you directly about why this keeps happening. No complicated charts, no blame, no scare tactics. Just the real reasons people struggle with investing and the habits that quietly work against them without them noticing. Before we go any further, if you appreciate honest conversations about money and long-term thinking, take a second to like this video, subscribe to the channel, and turn on the bell so you don't miss future videos like this. They chase hot stocks? Here's what usually happens. Someone hears about a stock that's gone up 300% in the last month. Maybe it's a friend bragging at a party, or they saw it trending on social media. And suddenly they feel this urge, this fear of missing out. They think if they don't jump in right now, they'll miss their chance to get rich. So they throw their money in without doing any research. But here's the thing. By the time you hear about a hot stock, the big gains are usually already gone. The smart money got in early and is now selling to you. You end up buying at the peak, and when the hype dies down, the stock crashes. You're left holding the bag, watching your money disappear. This happens over and over because people confuse investing with gambling. They want quick wins instead of long-term growth. They don't understand what they're buying. Most people buy investments they don't understand. They hear a company name or see a fancy chart and think that's enough. But if you can't explain what a company does, how it makes money, or why it's valuable, you have no business owning it. Warren Buffett has a simple rule. Never invest in a business you can't understand. But people ignore this advice all the time. They buy crypto without understanding blockchain. They buy tech stocks without knowing the technology. They invest in companies operating in countries and industries they know nothing about. And when things go wrong, and they will, these investors panic because they never understood what they owned in the first place. They don't know if the drop is temporary or if it's a sign of something seriously broken. So they make emotional decisions instead of informed ones. They let emotions control their decisions. Fear and greed. These two emotions destroy more portfolios than anything else. When the market is going up, greed takes over. People see their neighbors getting rich and they want in. They start buying everything, taking on more risk than they can handle, convinced that stocks only go up. Then the market crashes, and suddenly fear takes control. They see their account balance dropping and they panic. They sell everything at the worst possible time, locking in their losses. Then they sit on the sidelines, too scared to get back in, and they miss the recovery. This emotional roller coaster is exhausting and expensive. The best investors are boring. They stick to their plan, whether the market is up or down. They don't let the daily noise shake them out of good investments. They try to time the market. Everyone wants to buy at the bottom and sell at the top. It sounds simple enough, right? Just sell before the crash and buy before the rally. But here's the reality. Nobody can consistently predict short-term market movements. Not the experts with fancy degrees. Not the people on TV. Nobody. Yet people keep trying. They sell when they think the market is about to drop. Then they wait for the perfect moment to buy back in. But that perfect moment never comes, or they miss it. Meanwhile, the market keeps going up without them. Studies have shown that missing just the 10 best days in the market over a 20-year period can cut your returns in half. And those best days usually come right after the worst days, when everyone is too scared to invest. The investors who make money are the ones who stay invested through the ups and downs, not the ones trying to jump in and out. They don't diversify properly. You've probably heard the old saying, don't put all your eggs in one basket, but many investors ignore it anyway. They get attached to a single stock, sector, or industry and pour all their money into it. For example, someone working in tech might only buy tech stocks because that's what they understand. Or they might be so convinced about one company's future that their entire portfolio revolves around it. The problem is simple. This is extremely risky. If that one investment underperforms, crashes, or fails completely, you could lose a huge portion, or even all, of your money. That's why diversification is critical. It means spreading your investments across different asset types, industries, and even countries. You avoid putting too much in any single area and reduce the risk of catastrophic loss. Of course, diversification has a trade-off. You might not hit it big with one lucky pick, but that's the point. Investing isn't just about chasing the home runs. It's about protecting your money while steadily growing it. By diversifying, you can ride out volatility, minimize risk, and increase the chances of long-term success. They fall for get-rich-quick schemes. The internet is flooded with people claiming you can turn $1,000 into $1 million almost overnight. They post screenshots of supposed profits, flaunt their luxurious lifestyles, and claim to have secret strategies or insider knowledge. For someone desperate to believe there's an easy way to wealth, it's tempting to fall for these stories. Many people take the bait. They pay for expensive courses, follow advice from strangers online, or get involved in pump-and-dump schemes, thinking they found the shortcut. And what happens? They end up losing money, sometimes substantial amounts, because these shortcuts are rarely legitimate. Here's the reality. Building real wealth through investing takes time, discipline, and patience. It's not flashy or exciting. It's about consistently putting money into solid, reliable investments and letting compound interest work over years and decades. Anyone promising quick riches is either lying or trying to sell you something. Real financial growth isn't about tricks, hacks, or gambling on the next hot tip. It's about slow, steady, and smart investing. Over time, that consistent effort is what separates the people who achieve financial freedom from those who chase illusions and end up empty-handed. They pay too much in fees. This is one of those hidden traps that catches investors off guard. Fees are silently eating into your returns. Many people don't realize how much money disappears every year simply because of the costs associated with investing. For example, you might be working with a financial advisor who charges 2% of your assets annually. That doesn't sound outrageous at first, but over decades, it becomes a massive drain. Others are constantly buying and selling stocks, racking up trading commissions every time they make a move. Then there are mutual funds with high expense ratios, sometimes 1% or more per year. Each of these fees chips away at your investment returns, often without you noticing. Here's the impact in numbers. Say the market returns 8% per year, but you're paying 2% in advisor fees. Your actual return drops to 6%. Over 30 years, that difference is staggering. A $100,000 investment growing at 8% becomes about $800,000, but at 6%, it only grows to $570,000. That's $230,000 lost purely to fees, money that could have stayed in your pocket or compounded further. The solution is straightforward. Keep your costs low. Choose low-cost index funds with expense ratios under 0.1%. Minimize unnecessary trading and carefully evaluate whether high-fee advisors or funds are really worth it. Over time, controlling fees can be just as powerful as achieving higher returns, because more your money stays invested and grows for you. Small percentages might seem insignificant, but over decades, they compound into a massive difference. They give up too soon. Investing is a marathon, not a sprint, but most people treat it like a sprint. They invest for a few months or maybe a year. Things don't go the way they hoped. Maybe the market drops or their investments underperform. So they get discouraged and quit. They pull their money out and say investing doesn't work. But here's what they're missing. Short-term results are basically random. You might have a great year or a terrible year, and it doesn't mean much. What matters is what happens over 10, 20, or 30 years. The stock market has historically returned about 10% per year on average, but that's over long periods. In any given year, it could be up 30% or down 20%. If you're not willing to ride out those swings and stay invested for the long haul, you'll never see the real benefits of investing. Success in investing isn't about being smart or lucky. It's about being patient and consistent. Listen, I know this all sounds intimidating. You might be thinking that investing is too risky, too complicated, too easy to mess up. But here's the thing. Once you understand these mistakes, you can avoid them. You don't need to be a genius to invest successfully. You just need to be disciplined. Invest in things you understand. Diversify. Keep your costs low. Control your emotions. Stay invested for the long term. Do these things, and you'll already be ahead of 90% of investors out there. The path to building wealth isn't mysterious or complicated. It's actually pretty straightforward. Most people just get in their own way. Don't be one of them.